This is a lovely photo of a waterfall. Does it remind you of something? If not, let me describe it to you. The S&P 500 is down 7 days in a row, the longest losing streak since November 2016, the worst month since February 2009, equal to December 2018's drop, the worst week since Lehman in October 2008. The Dow is down 7 days in a row. The Dow volume today hit an all-time high record. The world's stocks lost $5 trillion in market cap in the last 7 days. The VIX exploded 30 points higher in February, its biggest monthly spike ever. Bank stocks suffered their biggest weekly drop since March 2009. Airline stocks suffered their biggest weekly drop since March 2009. Two-year yields fell 39 basis points in February, the biggest yield drop since November 2008. Treasury volume was the highest since September 2013. Silver suffered its worst monthly drop since May 2016. Friday was gold's worst day since June 2013, and oil collapsed again in February for the worst start to a year since 1991. So, let's take a look. From the peak in the S&P 500, it took only 7 days to reach correction territory. This is the fastest pace in history. And looking at this chart, is the trend your friend? The Dow, in similar fashion, crashed from peak to correction at its fastest pace since 1928, right before the Great Depression. For dramatic purposes, the current Dow is in the blue, while the Dow from 1928 to 1932 is shown in red. And is that the path forward? And so the question is, how does the NASDAQ shape up? Well, this chart shows the current NASDAQ in green, and the NASDAQ up and through the dot-com crash is shown in red. It makes one wonder, doesn't it? Let's now go to our charts. So the charts we looked at, those were for dramatic purposes. I don't know if it's going to get as bad as the dot-com crash or the great financial crisis, but it definitely was a quick elevator down. From the peak here down to this point here took 7 days. And now we're looking at the 5-year on the S&P, the spiders, simply for a little bit more context, because this doesn't happen every day. The close on Friday, 296.26. Now, within this time frame, the only other thing that compares is there in late 2018, the peak, and then the bottom at that point. But that took a lot longer. These other two periods here, early 2016 and say late 2015, still don't compare. We sliced right through the 20, the 50, and the 200 EMAs. Let's take a look at the MAC. MAC is here. We're at a negative 5.295 at that point here. So that's pretty quick. Again, the only other time that really compares is late 2018. Now its first dive down happened at that point there from this peak up here. Now that's consistent with this current move. So are we going to have a rebound and then another dive down? We don't really know at this point. We'll have to pay attention. Moving on down here into the histogram, this certainly was the worst in this entire time frame. Moving here into the price rate of change as well, pretty bad. The only other comparison is here late 2018. Looking at these other oscillators, I think we're going to find much the same. This level here, again, late 2018 at that point there, and then this 2015. So not too many other events occurred similar to the current event. Stochastics, much the same, except you do have a few more examples going all the way back. Volume, definitely bad. Here, compares worse than this. Not sure what this is here. Worse than this, and maybe comparable there to 2015. So even late 2018, there and there, were not as bad. Into the Williams, you're probably not going to be able to make much from that. So back up here to the price chart. Now, looking at the price chart, definitely, I would imagine that we're going to have a V recovery, at least a rebound. We'll see if it's a dead cat bounce or not. And we'll have to follow it to find out if we do attempt what we did in late 2018 with the dive down and then the double top here and then the subsequent dive down there. While you're thinking about the markets this weekend, keep this in mind. Markets don't crash when they're overbought. Markets crash when they're already oversold, and that's where we are. And what it essentially means is that we've gone through a pretty difficult 7-day period, but it could get worse. Right now, we're oversold. So there's only two ways to think about the current market. If you believe the coronavirus crash is overdone, maybe stick your toes in and do some bottom fishing. But if you believe the current market is more like 2008 to 2009 and the great financial crisis, then things are not over and you are better staying on the sidelines. Regardless, you need to sleep at night. So don't place yourself in a position where you're relying only on hope because hope is not a plan. So be safe, and for today, that's ChewDog Charts. Thank you.